A lot of people say their favorite season is fall. Mine's winter, but we're not here to talk about that kind of season. Today, it's all about earnings season. Third quarter earnings season is well underway. What does the UBS Chief Investment Office expect from the companies that are reporting? And what does the guidance from those companies tell us about what to expect in the economy next year? We'll break it all down for you right here on UBS Trending. Hi everybody, welcome to UBS Trending. I'm your host, Carrie Breen. Matthew Torme is in the studio to break down the latest Q3 earnings reports. Hey Matt, thanks for being here. So can you tell me, what are CIO's expectations for third quarter earnings?
Yeah, so we are expecting a generally good third quarter earnings season, and this should be largely driven by a still healthy labor market. For example, in the September jobs report, unemployment was unchanged near historically low levels, non-farm payroll growth is still solid, and participation in the labor force is continuing to improve. Additionally, weekly initial jobless claims are at benign levels, and there's also more job openings out there still than there are unemployed workers. So given this strength in the labor market that we have been seeing, economists have been revising higher their third quarter GDP estimates, with the consensus view up from 0% to start the quarter to 3% today. So as a result, we are expecting the earnings recession to be over, and profit growth should return to positive territory here in the third quarter. And we think that there's going to be three key reasons why this will happen. First, unlike GDP, S&P 500 profits skew more towards goods rather than services. And the shift away from goods consumption that we saw last year was a pretty big drag on profits. But we do think that we are in the later stages of this goods slowdown, and this should weigh less on profits going forward. Second, S&P 500 margins should continue to improve as input costs fall at a faster rate than broader inflation as measured by both the consumer and producer price indices. And third, if we look at the Magnificent Seven stocks that have been driving U.S. equity market performance this year, in aggregate, their earnings are projected to grow by more than 30% after declining in every quarter of 2022. So bottom line, we are expecting about 3 to 4% earnings per share growth this quarter, which does represent about a 3 to 4% beat relative to consensus expectations as well.
Great, that sounds like good news. Thanks, Matt. So I know we're still in the early stages of earnings season, but are there any key takeaways from the companies that have reported so far?
Yeah, so the results so far have actually been pretty fine. So the percentage of companies that are beating earnings and sales estimates is in line with historical averages, and this is actually a good sign because there's a pretty good correlation between what the beat rates are at this stage of the earnings season and where they're ultimately going to end up. And for these companies that have reported so far, if we look at their fourth quarter guidance for the median company, it's down by about a low single-digit percentage point, so not too worrisome from our view. Now, it is the first week of earnings season where we see the banks typically dominate results. So a few key highlights from here. First, net interest income is coming in generally above expectations, and mix shift into interest-bearing deposits is having less of a negative impact on funding costs than expected. Second, credit quality remains relatively benign. And third, the banks still remain well capitalized.
Okay, thanks, Matt. So now that we've set expectations for this earnings season, what's CIO's outlook for stocks for the next 6 to 12 months?
Right, so in our base case, we are still expecting a soft landing where the Fed can raise rates by just enough to tame inflation and slow down the economy without causing a recession. And we think that the consumer is going to be a key reason why this outcome can be achieved, despite some upcoming headwinds to spending, such as the resumption of student loan repayments, higher oil prices, and a tick up in mortgage rates. Because if we look at the health of the consumer, like we just talked about, Carrie, the labor market's still pretty solid. Recent revisions to household savings show that consumer balance sheets are actually in better shape than previously thought, and more than 90% of consumer debt is in fixed rate debt, which should offer some protection from higher interest rates. So in this scenario, we are expecting S&P 500 returns through the middle of next year to be in the low single digits before rebounding to our 4,700 price target by year end. Now, we did recently push out this 4,700 target from June of next year to December of next year, given the recent rise in yields that we've been seeing and our fixed income team's view that rates are likely to remain higher for longer, which does suggest lower than normal stock returns over the next 6 months. But if this recent rise in yields is due to more resilient economic growth, then stocks can rebound once rates stabilize, especially if the Fed's all but done raising rates.
So with this outlook in mind, how are you recommending that investors be positioned?
Yeah, so we're recommending investors have some balance between their cyclical and defensive exposures while incrementally adding to some of the laggards in the market. So from a sector perspective, we continue to like the energy sector, which is benefiting from higher oil prices, but the sector's performance has lagged the broader underlying commodities performance, so we think there's still some more room to run here. We also do like the industrial sector, which does provide exposure to a few secular growth areas that we think are still attractive in our view, such as higher defense budgets in the years ahead. And our preferred defensive sector is consumer staples, which should continue to benefit from resilient consumer spending. We do think that the sector is still attractively valued in our view, and the sector should also provide some portfolio protection in the event of a hard landing. And from a style perspective, we still like value stocks relative to growth stocks, given that growth stocks are still really expensive relative to value stocks. And within the mega cap growth complex, there's some elevated expectations here. So if we think there's any hiccup in the outlook going forward, this could prompt investors to rotate into value stocks and other segments of the market that have lagged in our view.
Okay, thanks so much, Matt. Thanks for being here. For more information, visit www.ubs.com/views and make sure to follow UBS on social media. And check out our Instagram channel at UBS Trending for UBS Studios content you can't find anywhere else. And as always, if you have any questions about your portfolio, please speak with a financial advisor. Until next time, I'm Carrie Breen. Have a great rest of your day, and remember to keep your eyes on what's trending.